Good morning, YouTube, or afternoon. It is 1:01 p.m. Today, I wanted to read an excerpt from my own book, the shortest book on investing, because I'm a dividend investor and I like to buy income, and I'm proud of it. So, yeah, I'm gonna read some pieces of my book. Be simple. If you like some of the content I put up, I do this thing called traffic therapy. I've been doing shorts on it. It's on my channel. If you like what you see, like and subscribe, and there follow. I also have my own T-shirt company. I have glitchyvisions.etsy.com and also glitchyvisions.shopify.com. Take a look on there. I have some of my favorite things on there. Godzilla T-shirts that I print out. I also got my plants collection. I got only plants, and I also got plants gone wild. So take a look at it. Hopefully, people out there see it. Glitchyvisions.etsy, glitchyvisions.myshopify. Take a look. So, I'm gonna read pieces of my book. The first chapter, the basic, dividend investing. What is it? First, let's look at the definition of a dividend. A dividend is a sum of money paid regularly by a company to its shareholders out of its profits. Therefore, when you invest some money into a company that pays dividends, you get paid more money. And if you reinvest that money, you get more money and more shares. And therefore, it makes you got it, more money. It's money making more money. So let's say for AT&T, we we want to get $100. You simply get that $100 divided by the dividend yield and divide that by 100. That'll give you an estimate of $1,692 that you need to invest to get $100 a year. To get $1,000, you need to do about 16,000. That's not a lot of money just to get $1,000, but it's all about long-term holding and investing. I always start at $100. Why? Because I know I have to crawl before I have to run, etc. I do I do that calculation, the dividend yield divided by 100, and then also I take the what I want to get divided by the dividend yield divided by 100. And also with all my investings accounts, I have a drip where money is just reinvested to get me more shares of, of whatever security or ETF I'm involved in. The way I look at dividend investing and buying an asset is each dollar is at work 24/7. A robot building more robots. It's an income factory. Your money's constantly working, constantly churning, never standing still, and that money has to work to make you more money. Coke pays at the time I wrote this. Coke pays 44 cents a year and trades at the time $63.64 with a dividend yield of 2.74%. To get one share a year, if you need to invest about $2,300, give or take. Invest and hold, and eventually you'll be bringing in extra shares and some fractional shares to build wealth. And here's the one thing I always trip about is fees kill wealth. I had a family member who got me into two funds, GUT and GAB. GUT's expense ratio is 1.75%, and GAB is 1.37%. And those fees were pretty high. I was losing a whole quarter of uh, of profit just to the fees, and I didn't like that. As I educated myself more and more and more every year, I realized, holy crap, these fees are juicing me blind. So what did I do? I invested in SPY. I sold all of those, both those stocks and ETF, both those ETFs, and invested in SPY and VOO. I had one in my traditional IRA and one in my Roth IRA. I had the traditional IRA because when I left the job, I got money out of the in my 403b, but it had to be put into a regular traditional IRA. So I put in traditional IRA, about $2,000. So I put into that company. I was making a decent amount of money, but when I figured about the expense ratio and how much I was losing every single year, I was like, I can't be doing this. So I changed it over to SPY, and that turned out to be a better decision for me because the expense ratio is a lot lower. And following the S&P 500, I'm getting the gains of the top 500 companies around. And I so far in the 4 or 5 years that I've been investing into SPY and VOO, I've gotten back a return on investment of 30% uh, on on both of them, and and a growth of 1,000 over $1,000. With VOO trying to get to $10,000, VOO being in my Roth IRA. Once I get to $10,000 into that account or into that security for VOO, the compounding will get a lot better. So I learned my lesson with that. And fees kill wealth. All the top books will tell you that. Everything from Rich Dad Poor Dad to the Little Red Book Common Sense Investing, Random Walk Down Wall Street, um, Common Sense Investor, Psychology of Money, um, all these investing books, the biggest books out there, including, but not really including the Income Factory. Income Factory doesn't take into account fees, but fees will kill wealth, and that's a reality. Anything that's anywhere close to 1% will you'll be losing a lot of money to that expense ratio. There's many calculators out there that you can use to figure out just how much money you're losing to the expense ratio. And the expense ratio is like Pac-Man, just keeps eating and eating and eating and eating. So that's why I care about that all the time. Next, you want to know about is the rule of 72. The rule of 72 is a it is used to estimate the number of years required to double invested money at a given annual return. For AT&T, you're looking at 12.18 years. For Voom, you're looking at 50 years to double your money. And that's because it has a dividend yield of 1.5%. And at the time of writing this, AT&T had 5.9%. So naturally, the higher the dividend yield, the faster it will take to double your money. If you have a dividend yield of 10%, it'll take exactly 7 years to double your money. There is stuff out there, really expensive mutual funds, expensive ETFs, and they might give you 10%, but their expense ratios might be super high. Always look at the expense ratio before you start investing, and your wealth will grow all the much faster and move a lot further. I invest personally in two different Roth IRAs, one with Fidelity and one with Merrill Edge. Merrill Edge being my main one. With Fidelity, since I'm able to invest in fractional shares, I have two ETFs in my Fidelity Roth IRA, JP, 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 JEPI, JEPI, and QILD. Those are my pure income uh, Roth IRA. If I get those to $10,000, it's almost like a set and forget it. Right now, I got $2,000 in JEPI and $1,000 into QILD, and I'll be getting approximately 200 some odd dollars a year just in dividends. And of course, I'm reinvesting it. This year, 2024, if I'm able to fully fund my Merrill Edge Roth IRA by getting boom to $10,000, which would be about additional investment $4,500, then I can put another $1,000 into QILD, get both QILD and JEPI to $2,000, and the income from that's going to just keep increasing exponentially. They're going to be buy and hold forever. That's basically what it is. The world's hair is on fire. The world's hair is on fire. What does that mean? Well, Mr. Market, the stock market, being the best uh, wealth creator in the world, has its ups and downs. A lot of people is conditioned to worry about the price going up, going down, going up, going down. These are people who trade on a frequent basis. Now, trading, you're constantly looking at, is this go up a certain percentage point? Has this gone up a certain number of dollars, cents, whatever? You're looking at that, and you're constantly looking at charts, candlesticks, etc., etc. I'm too lazy for that, to be honest. I don't want to have to be doing that. I would rather just buy a company that's been around for a while. Uh, Gives me a pretty good dividend yield, about 3 to 5%. That for me is pretty good because anything higher sometimes kind of worries me a little bit. A lot of the top binds say, if you're going to be going for these high yield companies, high yield usually means high risk. They could be just attracting investors. They could just be getting off the ground, whatever it is. So I go from 3 to 5%, eight maybe the highest, but It's all depending. So, what happens when the world's hair is on fire? By the time you and I learned, average Joe guy, dude working home 9 to 5. By the time you and I figure out what bad news came out at 7 o'clock in the morning, the market's already reacted. The numbers have changed. Uh, a lot of things have already reacted. The market being a rational place, people assume it to be, has already reacted to any kind of bad news, any kind of geopolitical craziness. So try not to let emotion and fear guide or hinder you in terms of investing. I like the saying, "Be greedy when everyone is fearful. Be greedy when there's blood in the streets, even if it's your own. Be fearful when everyone is greedy, because why? It means the stock market is going through the roof, all time highs, and the value of a stock, an ETF, or any other security is going bonkers, going straight up. So, 1 second, guys. Speaking, can I help you? Sorry, interruptions. Where was it? So yeah, when the market goes up, okay, slow your roll on investing. Still put some money in. Great. Stock market takes a massive dump. What do I do? If I have the money, I'm buying more shares. I'm buying a ton load more shares. Because why? Because then your money goes farther. You can buy more shares at a lower price. And then when your dividends come in and they get reinvested, they're buying more shares at, at close to bargain basement prices. When you're doing that, you're buying more shares. That means when the money, when the stock market recovers, as it always does, zoom out, people just zoom out. Once the stock market recovers, you're in the money and you didn't panic, you didn't sell everything, you stayed in place. That's basically how I deal with the stock market. Even during the Obama times, because that's when I started really seriously investing. Is around the middle of the first towards the second term of Obama, and I just saw red all over my portfolio, and I was like, you know what, fuck it. And at the time, I could only afford to do $25 a month, and I kept putting money in, kept putting money in, and then I finally made my first investment. I bought some Bank of America, some AT&T, set it, forget it, just left it there, let it grow dust, added whatever I could. Until I hit $300, buy more, and then I was reading, I believe it was Seeking Alpha and Motley Fool, and there was a tip that said, "Hey, top 7 stocks that are $7 or below, that's gonna double in 2 or 3 years." Bank of America was one of them. Bought Bank of America, and I bought JetBlue. I got like 7 or 8 shares of JetBlue, and then JetBlue took off, went up to $25 a share. When I finally sold it, it was at 20. It was went from 25 down to 22, and I sold it at 22. And I was able to get my first few shares of Apple. I bought like 5 shares of Apple. It was like $500. It was shortly after the stock split around that time, and I just held it. Bought another share about 2 months later. Just held it. Didn't do anything with it. Did the drip, and then recently they did another stock split. I think they did a 2 to 1. Ended up getting 17 shares of Apple. Then I ended up buying some. I bought the laptop I'm recording this on, an Apple Watch for the wife, some earbuds and stuff. So that I'm gonna buy. I'm gonna reinvest that money that I bought in Apple products back into Apple. Now I have about 25 shares of Apple, and I think I'm getting about $20 a year in dividends. And I apply that concept to most things that I do. If I buy Coca Cola, I buy Coca Cola shares. My kids go to McDonald's, I buy McDonald's shares. I owe McDonald's $80. Oh, by meaning I tax myself $80 to invest into McDonald's, so that every time my kids go, I do a pretty cool investment. And my passive that's in my passive income account. I got a whole bunch of companies in there that I use regularly, and I invest money into them. Let's see what's my next chapter here. The me tax. The me tax. That's an important one. What is the me tax? Well, we pay a whole lot of money to bills, gas, house upkeep. Everything gets paid first, but the last person we pay is us. the me tax for me, I tax myself automatically 15 to 20% of my paycheck. That money goes into investing into my uh, Roth IRA. It goes into supporting my business. It goes into my passive income account. 2024 this year, I'm gonna be putting more money into my Roth IRA, trying to get that to $4,500 and get VOO to $10,000. And then the other $1,500, 1,000 is going to go into QILD, and then $500 is going to split apart 250 into two holding accounts. My holding accounts are basically the money that's going to sit there for when I'm able to on January to invest a bulk amount, and then whatever I need to backfill to get to my goal amount for that year. Like for instance, next year $1,000 into Jeppy again, and then for Apple another $5,000, and I could put another 1,000 into QILD after I'm done with that, and then money into my business. So none of my money, none of my funds are they are not idle. All my funds are moving. And then what else do I got? And then I have the what's in your pocket thing. So I was knee deep in debt, balls deep. It took me almost 5 years to get out of debt, and I decided after I got out of it that I was gonna buy uh, Visa, American Express, and Mastercard, maybe Discovery too. I want to own them, and they can pay me for owning them, as opposed to me paying them for owning them. Understand? So this after this year, maybe towards December, I will buy myself uh, some Visa, Mastercard, American Express, and Discovery stock. Just have it there, so they can pay me for owning them, as opposed to me paying them for owning them. And that's a concept that a lot of people, a lot of my friends don't really understand, but it's pretty simple. Crypto, I don't really touch crypto all that much. Um, in the Random Walk on Wall Street, the newest edition, the author describes crypto as a castle in the sky. It's only worth what the next idiot's willing to pay. So I kind of stay away from that. And then proselytizing. The definition of the word proselyte, proselytizing is the action of attempting to convert someone from one religion, belief, or opinion to another. My way of proselytizing, complicated word, one of those $100 words, is to try to convince people to invest, to dividend invest, to ignore the emotion of the stock market, to ignore the emotion of geopolitical strife. Investing is quite easy. If the whole market took a dump and everything went to hell in a handbag, you'd have more problems, because you'd have worse problems, because if the entire market got wiped out, it's the end of the world. The market acts separately from the economy, acts separate from the world stage. The market reacts quicker than we can. It's kind of like a quick draw. But investing in dividends allows us to avoid a lot of that strife. Investing in companies that are so easy to run, an idiot can do it, because one day someone will. That's what I look for. I look for companies that've been around for a while, and then I look at my cupboard. I look in my grocery aisle. I look in the cleaning section of my house. I want to buy those companies. I look at the thing I drive. I want to buy that company, so on and so forth. So I'm going to sign off. And as I always say when I sign off, may your income be passive and your dividends be massive.